Before we begin, please note that the information presented in this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. The content shared here is based on publicly available data and my own analysis of the insurance industry. You should always consult with a qualified and licensed professional before making any financial decisions or purchasing an insurance policy. This presentation is not an offer or solicitation to buy or sell any insurance product. Your car insurance bill arrives. You open it and your heart sinks a little. The price went up. Again, you haven't had an accident. You haven't gotten a single ticket. Your car is a year older, which should make it less expensive to insure, right? So why are you paying more money for the exact same coverage you had last year? Feels like a scam. Feels unfair. And what if I told you that feeling is not only valid, but for over 90% of American drivers, it's the absolute truth? You are almost certainly overpaying for your car insurance. Not by a little. Potentially by hundreds or even thousands of dollars every single year. The reason why isn't some complex algorithm or a secret handshake you're not a part of. It's simpler and frankly more infuriating than that. You're overpaying because you're playing a game without knowing all the players. You've been led to believe there are maybe 10, 15, 20 car insurance companies in the entire United States. You know their names. You see their commercials every 10 minutes. The talking lizard, the guy in the red shirt, the emu, the jingles that get stuck in your head for days. These companies spend billions, with a B, every year to make sure they are the only ones you think of when you hear the words car insurance. But what if I told you that those household names represent just a tiny fraction of the market? What if I told you there is an official list, a master directory, of every single licensed auto insurance company operating in the United States? And that this list contains not 10, not 50, but hundreds of companies? Companies you've never heard of. Companies that don't spend $1 billion on Super Bowl ads, and instead pass those savings directly on to you. This isn't a conspiracy theory. This is the reality of the US insurance market, and for the next 10 parts of this series, we are going to pull back the curtain and explore that official list, company by company, category by category. My promise to you is this. By the end of this series, you will understand the auto insurance landscape better than 99% of the population. You will know the difference between a captive agent and an independent broker. You will understand what a mutual company is versus a stock company, and why that distinction can save you a fortune. You will discover regional giants that dominate their home states with incredible rates, and specialized insurers that offer unbeatable prices if you fit their niche profile. You will be armed with the knowledge to stop being a passive price taker and become an expert negotiator of your own financial future. You will stop wondering if you're getting a good deal, and you will know how to go out and get one. This is not just a list. This is a roadmap to financial empowerment. It's the playbook the insurance companies don't want you to have. So let's begin. To understand the world of auto insurance, we first have to understand the concept of market share. Think of it like a giant pizza. The entire pizza represents every dollar spent on personal auto insurance in the United States in a given year. That's a pizza worth over $300 billion. Each company's market share is the size of their slice. And you might be shocked to learn just how much of that pizza is eaten by just a handful of companies. The top 10 insurance carriers in the US control over 75% of the entire market. 75%. That means 3 out of every 4 insurance dollars spent in this country go to one of just 10 companies. This is the definition of a concentrated market. These are the titans, the behemoths, the household names we all know. And this is where our journey begins. We have to understand the giants before we can appreciate the advantages of the smaller, more agile players. So let's start at the very top, with the undisputed king of the mountain, the company with the single largest slice of that $300 billion pizza. We're talking about State Farm. With around 18% of the total market share, State Farm is a force of nature. If US auto insurance were a football game, State Farm wouldn't just be the star quarterback. They'd be the quarterback, the head coach, and they'd probably own the stadium too. Founded in 1922 by a retired farmer named George Metchelly, State Farm's original concept was revolutionary. He believed that farmers and rural drivers were lower risk than city drivers, and therefore deserved lower premiums. He built his company on a mutual model, meaning the policyholders are technically the owners. We'll dive deeper into what that means later, but for now, know that it's a key part of their identity. The defining feature of State Farm, and what makes them so different from many of their top competitors, is their agent model. State Farm operates primarily through a network of what are called captive agents. This is a critical term to understand. A captive agent is an insurance agent who works for only one company. That State Farm agent down the street with the red sign? They can sell you State Farm insurance. That's it. They can't offer you a quote from Progressive or Allstate. They are captive to State Farm. This has huge pros and cons for you, the consumer. The pro is a personalized, one-on-one relationship. Your State Farm agent is often a local small business owner in your community. They know your name, they know your family, and they can provide a high level of customer service and guidance. When you have a problem, you have a specific person to call. For millions of Americans, that peace of mind is worth everything. The con: you're only seeing one slice of the pizza, and it's always State Farm's slice. Your agent's job is to find you the best policy within the State Farm ecosystem. They can't tell you if a competitor across the street could save you 40%. Their toolbox contains only State Farm products. So while State Farm might be the perfect fit for many, especially those who value service and a personal relationship over pure price, relying solely on a captive agent means you might be leaving significant savings on the table. Next up, holding the second largest piece of the market pie is Geico. And if State Farm is the friendly neighbor, Geico is the hyper-efficient, tech-driven behemoth that wants to cut out the middleman entirely. Geico stands for Government Employees Insurance Company, a name that reflects its origins in 1936, when it was founded to provide insurance to federal government employees and their families. Today, of course, they serve a much broader audience, and their business model is the polar opposite of State Farm's. Geico is a direct-to-consumer writer. They don't have a vast network of local agents. Instead, they pour that money, billions of it, into advertising and technology. Their goal is to get you to their website or their app and have you buy a policy in 15 minutes or less, with no human interaction required. This model is built on two pillars: price and convenience. By eliminating the commission costs of a massive agent network, Geico can often offer some of the lowest rates in the industry, particularly for drivers with clean records. Their entire brand is built around the idea of saving you money quickly and easily. The trade-off, of course, is service. When you have a claim or a complex problem with Geico, you're not calling Bob, your local agent. You're calling a massive call center and speaking with a different representative each time. For people who are tech-savvy, self-sufficient, and prioritize their budget above all else, the Geico model is incredibly appealing. But for those who want a guiding hand to walk them through the complexities of insurance, it can feel impersonal and frustrating. These two companies, State Farm and Geico, represent the two fundamental philosophical approaches to selling insurance in America: the agent-based relationship model and the direct-to-consumer price model. Nearly every other company we will discuss falls somewhere on the spectrum between these two giants. Understanding this core difference is the first, most crucial step in taking control of your insurance choices. You have to first decide what you value more: a personal relationship or a digital-first, low-cost experience. Because as we're about to see with our next company, some players are trying to have it both ways. And that attempt to have it both ways brings us to a giant in the industry, a company that feels both incredibly modern and surprisingly traditional. A name you know not just from their ads, but from their relentless innovation that has shaped the entire market. I'm talking about Progressive. At first glance, Progressive seems like a contradiction. How can a company be one of the pioneers of selling insurance directly to you online, while also relying on over 38,000 independent agents? How can they be the face of digital, do-it-yourself insurance, while simultaneously empowering the very middlemen that digital insurance was supposed to eliminate? The answer lies in a story that starts long before the internet, with a radical idea: insuring the people nobody else wanted. Back in 1937, most insurance companies were incredibly selective. They wanted the perfect driver. No accidents, great job, stable life. If you were a little bit riskier, maybe a younger driver or someone with a spotty record, you were often out of luck. Two lawyers, Joseph Lewis and Jack Green, saw this not as a problem, but as a massive untapped market. They founded Progressive with the mission to provide insurance for these non-standard drivers. From its very first day, the company's DNA was coded with a willingness to look at risk differently, to use data and innovative thinking to serve customers the old guard had written off. This mindset led to one of their first major breakthroughs, the drive-in claims service. Think about how revolutionary this was at the time. Instead of waiting for an adjuster to come to you, which could take days, you could drive your damaged car directly to a Progressive center, get it assessed, and often leave with a check that same day. It was fast, it was efficient, and it was built entirely around the customer's convenience. This wasn't just about processing claims, it was a statement. It said, "We respect your time, and we want to make this painful process as easy as possible." This customer-centric, efficiency-obsessed approach would become the blueprint for everything they did next. But the real explosion happened when the founder's son, Peter Lewis, took over. He was a visionary who saw the future of insurance not in fancy office buildings, but in technology and data. Long before anyone else, he poured hundreds of millions of dollars into building a sophisticated, tech-driven company. In 1995, Progressive launched the first-ever insurance company website. Let that sink in. This was the era of dial-up modems and AOL. Most companies were still figuring out email, and Progressive was building a digital storefront. By 1997, you could buy a policy from them online. They were light years ahead of the competition. This technological leap wasn't just for show. It was the engine for their entire business model. It allowed them to collect vast amounts of data, refine their pricing with incredible precision, and most importantly, lower their costs. By automating so much of the process, they could pass those savings on to the customer. This was the birth of the Progressive we know today, the direct-to-consumer titan. And they didn't just sell their own product. They did something completely unheard of. They introduced the comparison tool. On their own website, Progressive would show you their rate right next to the rates of their biggest competitors. It was a move of shocking transparency. The implicit message was, "We are so confident in our pricing that we're willing to risk you choosing someone else right on our own turf." This built an incredible amount of trust. Even if you didn't buy from them, you used them as a benchmark. They became the Kelley Blue Book of insurance quotes. They made price shopping the industry standard. But here's the twist in the story. While building this direct-to-consumer empire, they never fired their other army, the independent agents. Why? Because Peter Lewis understood a fundamental truth about American consumers. We love choices. Some of us want to go online at midnight, get a quote in 5 minutes, and never speak to a human. Others want to sit down in a local office, talk to a person they know, and have them explain the difference between comprehensive and collision coverage. They want someone who can bundle their auto with their home or business insurance, someone who acts as their personal advisor. Instead of forcing everyone into one box, Progressive decided to compete on both battlefields. Their direct-to-consumer business, with its massive advertising budget and iconic character, Flo, would capture the online shoppers. Their independent agent channel would capture the customers who wanted a more traditional, high-touch experience. It was a brilliant two-pronged attack. The two channels technically compete with each other, but they both feed the same mothership. This dual strategy is Progressive's secret weapon. It gives them a reach that few companies can match. They can be the cheap, fast online option and the trusted local advisor, all at the same time. Today, this obsession with data and technology has evolved into their most famous, and perhaps most controversial product, Snapshot. The little device you plug into your car, or the app on your phone that tracks your driving habits. This is the ultimate expression of their founding principle. Don't judge a driver by their demographic, judge them by how they actually drive. The promise is simple. If you're a safe driver, you prove it with data and you get a discount. No more being lumped in with other people in your age group or zip code. Your rate is based on you. For millions of drivers, it's been a game changer, delivering significant savings. But it's also a deal with the devil for the privacy conscious. Snapshot monitors when you drive, how fast you accelerate, and how hard you brake. A late-night drive to the 24-hour pharmacy or slamming on the brakes to avoid a deer could potentially count against you. It's a direct trade. Your personal driving data in exchange for a potentially lower premium. For many, the savings are worth it. For others, it's a line they're unwilling to cross. So, who is Progressive for? It's for the consumer who craves options. It's for the person who wants to start their research online, but might want the safety net of calling an agent to finalize the deal. It's for the good driver who is confident enough to put their skills to the test with Snapshot and reap the financial rewards. It's for the individual who appreciates transparency and wants to see how the competition stacks up, even if it's on Progressive's own website. However, it's not a perfect fit for everyone. While they offer comparison rates, they aren't always the cheapest. And the personal relationship you get through an independent agent isn't quite the same as a dedicated agent from a company like State Farm. An independent agent works with many companies, so while they offer choice, they aren't a sole representative of the Progressive brand. You're a client of the agent first, and a Progressive policyholder second. Progressive's story is one of calculated risk and relentless innovation. They saw the future and started building it a decade before anyone else. They managed to crack the code on being both a low-cost, digital-first powerhouse and a champion of the traditional independent agent. They laid the digital highway for the entire industry. But while Progressive was busy building a complex system that could do everything for everyone, another company was watching. They saw the power of Progressive's direct-to-consumer model and decided to take that idea, strip it down to its absolute essence, and perfect it. They wouldn't bother with agents. They wouldn't bother with complicated choices. They would build a machine laser-focused on one thing and one thing only: efficiency. They put a charming little gecko in the driver's seat and floored it, turning a simple promise of 15 minutes could save you 15% or more into a multi-billion-dollar empire that would challenge everyone. And that challenge wasn't just about catchy slogans. It was a fundamental assault on the very structure of the insurance industry. GEICO, which stands for Government Employees Insurance Company, started with a brilliant, almost deceptively simple insight. Back in 1936, Leo and Lillian Goodwin realized that a specific group of people, federal government employees and top-ranking military officers, were statistically more careful drivers. They were a lower risk. So, if you only insured them and you cut out the middleman, the insurance agent, you could offer rock-bottom prices and still make a handsome profit. This was the seed of the direct-to-consumer model. No fancy offices in every town. No commissions paid to an army of agents. Just a direct line between the company and its low-risk customer. For decades, this was their quiet, effective strategy. But then, in the 1990s, with the backing of the legendary investor Warren Buffett, GEICO decided to take its secret weapon public. They weren't just for government employees anymore. They were for everyone who wanted to save money. And how would they reach everyone? Through a relentless, inescapable, and frankly genius marketing blitz. The gecko, the caveman, Maxwell the pig. It was an all-out assault on the airwaves. But behind the humor was that same cold, calculating efficiency. The ads all funneled you to one of two places: their website or their 1-800 number. They were turning the traditional insurance agent into a relic. Why talk to a person for an hour when a gecko promised you it would only take 15 minutes? This direct model was a revolution. It stripped away layers of cost and complexity, and passed a portion of those savings to the customer. It was a business model built for the internet age before the internet age was even in full swing. Warren Buffett didn't invest in GEICO because he liked the lizard. He invested because he saw a low-cost producer. A company that had built a sustainable competitive advantage by being ruthlessly efficient. They treated insurance not as a relationship to be managed by an agent, but as a commodity to be sold as quickly and cheaply as possible. And for millions of Americans, that was a deal they were more than willing to take. But as GEICO was carpet-bombing the airwaves with its message of speed and savings, another company was quietly sharpening a different kind of weapon. A company that believed the key wasn't just in how you sold insurance but in how you priced it. This company was Progressive. If GEICO was the master of operational efficiency, Progressive was the master of data. They were the industry's mad scientists, founded in 1937 with a mission that seemed, at the time, completely insane: insuring high-risk drivers. These were the drivers everyone else turned away. To survive, let alone profit from this demographic, Progressive had to become exceptionally good at one thing: understanding risk. They couldn't just lump everyone into broad categories. They had to get granular. They had to slice and dice data with a level of precision no one else was even attempting. They were pioneers in using factors that are now standard, like a person's credit score, to predict their likelihood of getting into an accident. It was controversial, but it was effective. They learned to price risk not just by the car you drove or where you lived, but by who you were as an individual. While GEICO was focused on cutting costs out of the system, Progressive was focused on pricing the risk in the system more accurately than anyone else. This gave them a huge advantage. They could offer a surprisingly good rate to a driver who looked risky on the surface, but who their data showed was actually a safe bet. Conversely, they could charge a higher, more appropriate premium to someone who looked safe but whose data told a different story. For decades, this was their niche. They were the specialists, the company you went to when no one else would take you. Then, just like GEICO, they decided to go mainstream. But they brought their data-obsessed DNA with them. And they needed a way to communicate this core difference to the public. The answer came in the form of a perky, endlessly enthusiastic cashier in a white apron named Flo. Flo wasn't just a mascot. She was the friendly, human face of a complex algorithm. Her superstore wasn't just a fictional setting. It was a metaphor for choice and transparency. And her signature tool, the Name Your Price tool, was a masterstroke. It took Progressive's core strength, granular, data-driven pricing, and framed it as customer empowerment. You tell us what you want to pay, and we'll show you the coverage options that fit your budget. It brilliantly reversed the typical insurance shopping process. Instead of getting a single take-it-or-leave-it quote, the customer was suddenly in the driver's seat, playing with the variables. Behind the scenes, of course, Progressive's powerful computers were still calculating the risk and the price, but the feeling was one of control. And then they did something even bolder. They introduced the comparison rater, showing you not just their price, but the prices of their competitors, including Geico. This was the ultimate power move. It radiated confidence. Progressive was so sure their data allowed them to offer a competitive price for your specific risk profile that they weren't afraid to show you everyone else's numbers right next to theirs. It was a direct challenge, turning the act of buying insurance into a transparent head-to-head competition. This rivalry between Geico's efficiency and Progressive's data-driven pricing has defined the modern insurance landscape. And the newest battleground in their war for market share is your car itself. Both companies realized that the best way to know how you drive is to, well, watch you drive. This led to the rise of telematics and usage-based insurance. Progressive was once again the pioneer with Snapshot, a small device you plug into your car, or now just an app on your phone, that monitors your actual driving habits. How hard do you brake? How often do you drive late at night? How many miles do you cover? They were taking their data obsession to its logical conclusion, from predicting risk based on proxies like credit scores, to measuring risk based on real-world, real-time behavior. Good drivers could now get a discount based not on who they were, but on how they drove. Geico, a fast follower, launched its own version called Drive Easy. The race was on. This technology represents the ultimate convergence of their two philosophies. It's a direct-to-consumer model, with no agent required, that uses hyper-personalized data to create a hyper-accurate price. It's the Gecko's efficiency married to Flow's algorithm. This ongoing tech arms race is fantastic for consumers who are safe drivers, but it also raises new questions about privacy and what it means to be rated on our every move behind the wheel. The battle between these two giants, born from two different ideas of disruption, has forced the entire industry to become faster, smarter, and more data-centric. They created a new playbook for success. But while these two titans were busy building digital empires and fighting over gigabytes of driving data, a much older, more traditional giant was watching. A company built not on websites and algorithms, but on a massive nationwide network of human beings. A company that believed the agent wasn't an obsolete cost center, but was, in fact, their greatest weapon. And they were about to remind everyone why a friendly neighbor might still be more powerful than the slickest app. This titan of the industry wasn't born in a Silicon Valley garage or a Wall Street boardroom. It was born on a farm in Moline, Illinois. The year was 1922, and a retired farmer and insurance salesman named George Metchelly had an epiphany. It was a simple, almost laughably obvious idea, but one that the big city insurance companies had completely missed. He realized that farmers who drove less, on roads with less traffic, and parked their cars in barns instead of on crowded city streets, were a much lower risk than urban drivers. Yet they were all paying the same high rates. It was unfair. It was inefficient. And for George Metchelly, it was an opportunity. He founded a company with a simple premise: offer a better rate to a lower risk group. He called it State Farm Mutual Automobile Insurance Company. The name itself was a mission statement. It was for farmers, and initially it operated only within the state of Illinois. But Metchelly's secret weapon wasn't just his revolutionary pricing model. It was his distribution model. He didn't want to hire a faceless sales force. He wanted to build a network of people who were part of the communities they served. He recruited other farmers, local business owners, people who understood their neighbors because they were their neighbors. This wasn't just about selling insurance. It was about building a presence. While other companies were abstract entities in faraway cities, State Farm was the guy you saw at the local diner, the woman whose kids went to the same school as yours, the name on the back of the Little League jerseys. They built their empire not with 30-second TV spots, but with handshakes. They built it one small town, one suburban block at a time. Each agent was an entrepreneur, a franchisee of trust, running their own small business under the massive umbrella of the State Farm brand. For the customer, this model created a fundamentally different relationship with their insurance company. You weren't just a policy number in a database, you were a client. You had a name, a face. When you had a question about your coverage, you didn't call an 800 number and navigate a phone tree. You called Dave or Susan or Mike, your agent. When you had an accident, The first call you made wasn't to a claims hotline to speak with a stranger. It was to a person you knew, who could walk you through the chaos and advocate on your behalf. This is the core value proposition of the agent model. It's the promise of a guide. Insurance is complicated. The language is dense, the coverages are confusing, and the consequences of being underinsured can be catastrophic. The agent's job is to be your translator, your advisor. They can look at your whole life, your car, your house, your boat, your life insurance needs, and bundle them together not just for a discount but for a holistic protection strategy. That multi-line approach is where State Farm truly dominates. They don't just want to insure your car. They want to be the single phone call you make for every insurance need you have. The famous Jake from State Farm commercials aren't just selling a brand. They're selling the accessibility of having a dedicated person, available anytime. Of course, this model has its trade-offs. That friendly neighbor needs to get paid. The brick-and-mortar offices, the support staff, the agent's commission, all of that is overhead. And that overhead is baked into your premium. For someone with a simple policy and a clean driving record, it's entirely possible, even likely, that a direct-to-consumer company like Geico could offer a lower price for the exact same coverage. The agent model is also less flexible. Your agent can only sell you State Farm products. They can't shop around for you at Progressive or Allstate. You're buying into a single ecosystem. When the internet revolution happened, and direct writers like Geico started pouring hundreds of millions of dollars into advertising their low rates and digital convenience, the pundits predicted the death of the insurance agent. They were seen as dinosaurs, relics of a bygone era. Why would anyone want to schedule a meeting with an agent when you could get insured in 15 minutes from your couch? But State Farm didn't panic. They didn't abandon their greatest asset. Instead, they doubled down. They armed their agents with technology. They built a world-class website and a highly rated mobile app. They created a hybrid model. You can start a quote online, manage your policy on your phone, and file a claim through the app. But at every step of the way, your local agent is there, integrated into the process. The technology became a tool to make the agent more efficient, not a weapon to make them obsolete. They understood that for life's biggest and most stressful moments, a major car accident, a house fire, people don't want to talk to a chatbot. They want to talk to a person they trust. And the results speak for themselves. For 50 straight years, from 1972 all the way to 2022, State Farm was the #1 auto insurer in the United States by market share. Think about that. Through the oil crisis of the 70s, the economic boom of the 80s, the dot-com bubble of the 90s, and the entire digital revolution of the 21st century, they remained on top. They didn't do it by being the cheapest. They did it by being the most present. Today, they have something like 19,000 agents across the country. They are a deeply embedded part of the American landscape. Their financial strength is also a key part of their identity. They hold the highest possible rating from AM Best, the industry's credit rating agency. For you, the policyholder, this isn't just a boring financial metric. It's a promise. It's the assurance that no matter how big the disaster, a massive hurricane, a widespread wildfire, a devastating tornado, State Farm has the capital reserves to pay its claims. They have the financial bedrock to weather any storm, which means they'll be there to help you weather yours. So as we look at this giant on our official list, we see a company built on a paradox. A massive multi-billion-dollar corporation that operates with the philosophy of a small-town business. A tech-forward insurer that still believes its most powerful asset is a human being. They are the undisputed king of the agent model, a testament to the enduring power of personal relationships in an increasingly digital world. But what happens when a company looks at this model and decides to turn it completely on its head? What if, instead of focusing on human relationships, you focus entirely on the numbers, on the data, on the risk? What if you treat insurance less like a neighborly service and more like a high-tech science experiment, constantly tweaking variables to find the perfect price for every single individual? That brings us to another giant. A company that didn't want to be your neighbor, but wanted to be your quirky, data-obsessed lab partner, ready to offer you a deal if their calculations said you were worth the risk. That company is Progressive, and their story isn't one of cozy community building. It's a tale of calculated disruption, of seeing the entire insurance industry as one giant, unsolved math problem. While other insurers were trying to be your friend, Progressive was busy building the algorithm that would decide if you were even worth talking to. Founded in 1937 by two lawyers, Joseph Lewis and Jack Green, Progressive was born from a simple yet radical observation. The major insurance companies of the day wanted the safe customers. The farmers, the established families, the low-risk drivers. This left a massive underserved market of people who were considered higher-risk, younger drivers, city dwellers, people with less than perfect records. Other companies saw them as a liability. Lewis and Green saw them as a mathematical challenge, and more importantly, a business opportunity. Their founding principle was to provide insurance to these higher-risk drivers, but to do it profitably. This wasn't about charity. It was about being smarter than everyone else in the room. They named their company Progressive for a reason. It was a statement of intent. They were going to move the industry forward whether it wanted to or not. And they started innovating from day one. Think about the soul-crushing process of making a claim back in the day. You get into an accident, call your agent, wait for an adjuster to come out, wait for them to write a report, wait for the check to be approved, and wait for it to arrive in the mail. Could take weeks. Progressive looked at this and saw a colossal waste of time and money. Their solution? The world's first drive-in claims service. You'd get in a fender bender, and instead of waiting, you'd drive your car directly to a Progressive center. An adjuster would be waiting, assess the damage right there, and in many cases hand you a check on the spot. It was revolutionary. It treated the customer's time as valuable and streamlined the entire process, saving Progressive a fortune in administrative costs. They didn't stop there. They looked at how people paid for insurance. The standard was a lump sum payment once or twice a year. For the higher risk, often lower income drivers they were targeting, coming up with 6 months worth of premium all at once was a huge barrier. So, Progressive pioneered the option to pay for your auto insurance in installments. It seems completely normal today, but at the time it was a seismic shift. It made insurance accessible. It democratized the product. Again, this wasn't just a nice thing to do. It was a brilliant business move that opened up a whole new customer base that their competitors had ignored. But these early innovations were just the warm-up act. The real revolution came when Progressive embraced the digital age with an almost fanatical zeal. While other legacy companies were still running on paper files and mainframe computers, Progressive saw the internet not as a curiosity, but as the ultimate tool for risk assessment. In 1997, they became the first major insurer to launch a website. And soon after, they did something that made every other CEO in the industry think they had lost their minds. They started showing customers not just their own rates but the rates of their competitors right there on the Progressive website. Think about how insane that sounds. It's like going to a Coca-Cola vending machine, and it tells you that the Pepsi in the machine next door is on sale. It was a move of supreme confidence. Progressive was betting that their data, their algorithms, and their pricing were so precise that for the customers they truly wanted, they would win on price more often than not. And even when they didn't, they won something far more valuable: trust. They transformed themselves from a company that just sells insurance into a trusted advisor for shopping for insurance. This single move positioned them as transparent, customer-focused, and, frankly, the smartest choice in the market. Of course, you can't talk about Progressive's modern era without talking about Flo. In 2008, they launched a character that would become one of the most iconic advertising mascots of all time. But Flo wasn't just a quirky, funny character in a white apron. She was the human face of Progressive's complex, data-driven engine. She represented the brand's core mission: to make insurance simple. While the algorithms in the background were crunching petabytes of data, Flo was on your screen with a friendly smile, holding the Name Your Price tool. This tool was another stroke of genius. Flip the script. Instead of being told what you have to pay, you told the company what you wanted to pay, and it showed you a package that fit your budget. It gave the customer a sense of control in a process where they usually have none. Flo and her superstore weren't just selling a product. They were selling a smarter, easier, less intimidating way to buy it. This obsession with data reached its ultimate conclusion with the launch of Snapshot. Telematics, the little device you plug into your car, or the app on your phone, that tracks your every move behind the wheel. How hard you brake, how often you drive late at night, how many miles you cover. To critics, it was a big brother invasion of privacy. But to Progressive, it was the final piece of the puzzle. It was the fulfillment of their founding mission to price risk with surgical precision. Why should a safe driver who works from home pay the same as a reckless driver who commutes 2 hours a day, just because they live in the same zip code and drive the same car? Snapshot allowed Progressive to bypass demographic guesswork and price their product based on one thing and one thing only: your actual individual driving behavior. You weren't a statistic anymore. You were a data stream. And if your data was good, you got a discount. If it was bad, well, you were free to check their competitors' rates. This all ties into the one metric that Progressive is famously obsessed with, the combined ratio. In simple terms, it's the ratio of money they pay out in claims and expenses versus the money they take in from premiums. Most companies are happy if this number is just under 100, meaning they're making a small underwriting profit. Progressive aims to keep its combined ratio at 96. That means for every dollar they collect, they are determined to spend no more than 96 cents. This ruthless focus on profitability forces them to be incredibly disciplined. They can't afford to be sentimental. They can't afford to insure bad risks at a loss. Their algorithm is their Bible, and the data is its gospel. So, when you get a quote from Progressive, you're not just getting a price. You're getting the result of a decades-long experiment in data science. You're interacting with a finely tuned machine built to do one thing: assess your specific risk and offer you a premium that guarantees a 4-cent profit on every dollar. For millions of drivers whose data fits their model, they are the cheapest, most logical choice on the market. For millions of others, their quote is a polite but firm rejection. They're not trying to be your neighbor. They're not a good neighbor. They are a lab partner. They'll share their notes, they'll show you the formula, and they'll give you a grade. And in their world, that grade is the only thing that matters. But what if a company took a completely different approach? What if, instead of trying to solve the math problem for the entire population, they decided to focus on a single, highly defined group of people? A group bound not by their driving data, but by a shared code of honor and service. What if a company wasn't built for everyone but was built by and for the few? That company was born from rejection. It was forged in the simple, frustrating reality that a group of honorable men, serving their country, were deemed too risky to be trusted. The year was 1922. The automobile was no longer a novelty. It was a necessity. And for a group of 25 U.S. Army officers stationed in San Antonio, Texas, getting insurance for their cars was proving impossible. Insurers of the day looked at them and saw instability. They saw men who moved from post to post, men whose profession was inherently dangerous. In the cold, hard calculus of actuarial tables, a military officer was a bad bet. They were uninsurable. So they did what soldiers have always done when faced with an insurmountable obstacle. They relied on each other. Led by Major William Henry Garrison, they gathered at the Gunter Hotel in downtown San Antonio. And in that room they made a pact. If the established companies wouldn't cover them, they would cover themselves. They would form their own club, their own association, where each member would agree to insure the vehicles of the others. It wasn't a business plan cooked up in a boardroom. It was a solution born from necessity and a deep-seated trust in the character of their fellow officers. They drew up their own bylaws and elected officers. Each man chipped in. They weren't creating a corporation to generate profit. They were creating a reciprocal, a system of mutual self-help. They called it the United States Army Automobile Association. This wasn't just a new insurance company. It was a fundamentally different idea. The core principle wasn't profit, it was service. The customers weren't just customers, they were the owners. Every person they insured was a member, a stakeholder in the collective enterprise. This created a powerful, self-reinforcing loop. The association had a vested interest in treating its members exceptionally well, because the members were the association. And the members had a vested interest in being responsible, because their own actions directly impacted the financial health and premium costs for everyone in their shared community. This is the story of USAA. From those 25 Army officers, the idea began to spread like wildfire through the armed forces. The name soon changed to the United Services Automobile Association as they opened eligibility to officers in the Navy and Marine Corps in 1923, and the Air Force when it became a separate branch. They weren't running massive advertising campaigns. Their growth was fueled by something far more powerful: word of mouth in the tight-knit military community. A recommendation from a fellow officer carried more weight than any billboard. What made USAA's model so revolutionary was its profound understanding of its niche. While other insurers were trying to understand the entire chaotic American public, USAA focused on a group defined by a common culture of discipline, integrity, and service. They understood the unique life of a service member. They knew what a permanent change of station or PCS move entailed. They understood the financial strains of deployment. They built their entire operation around serving the specific, unmet needs of this community. When a member deployed overseas, USAA made it easy to suspend or reduce coverage. When a member moved to a new state, the transition was seamless. They weren't just selling a policy, they were providing a support system. This deep focus allowed them to defy traditional risk assessment. The rest of the industry saw a transient high-risk group. USAA saw a pool of responsible, disciplined individuals who were statistically less likely to file fraudulent claims and more likely to be diligent about payments. Their bet wasn't on driving data alone. It was a bet on character. And that bet paid off spectacularly. Because they were a member-owned reciprocal exchange, they weren't beholden to Wall Street shareholders demanding ever-increasing profits. When the association did well, when claims were low and investments performed, the surplus profits didn't go to outside investors. They went back to the members in the form of dividends, distributions, and lower premiums. For decades, USAA members would receive a check in the mail at the end of the year, a tangible reward for their collective responsibility. As the decades passed, USA methodically expanded its circle of trust. In the 1960s, they began offering eligibility to military widows and children of members. In the 1970s, they opened up to members of the National Guard and Reserves. And the watershed moment came in 1996, when they extended eligibility to all who had served honorably in the U.S. military, regardless of rank, enlisted personnel and officers alike. Finally, in 2009, they opened the doors to all military members, past and present, and their eligible family members, creating the broad community they serve today. But they didn't stop at auto insurance. They saw that their members needed more. They trusted the USAA name and the ethos behind it. So USAA expanded. They launched a banking division, offering checking and savings accounts tailored to military life, like fee-free ATMs worldwide. Because they knew their members were stationed across the globe, they moved into investments, life insurance, and homeowners insurance, becoming a full-service financial institution. Each new product was built on the same foundation that started in that San Antonio hotel: service to the member. This relentless focus on the member experience created a brand with a level of loyalty that is the envy of the corporate world. For years, USAA has been at or near the very top of virtually every customer satisfaction survey, from J.D. Power to Forrester. Their reputation became legendary. People would speak of their USAA moments, stories of claims adjusters going above and beyond after an accident, or of customer service representatives spending hours on the phone to resolve a complex issue. The company became a gold standard, a benchmark against which all other insurance and financial service companies were measured. But their greatest strength is also their most defining limitation: their exclusivity. You cannot simply decide to become a USAA member. You have to be eligible. You have to have a connection to the military. This velvet rope has created a powerful sense of identity and belonging among its members. It's a club, and membership is a badge of honor, a recognition of service. In a world where companies spend billions trying to appeal to everyone, USAA built a fortress of loyalty by proudly appealing to a select few. This model, however, is not without its modern challenges. As USAA has grown into a Fortune 500 behemoth with over 13 million members and hundreds of billions in assets, it faces the difficult task of maintaining the culture of an intimate association while operating at the scale of a massive corporation. The personal touch that defined its early years is harder to replicate with millions of customers. The annual dividends that members once cherished have become less common, as the company retains earnings to ensure its financial strength. Yet, the core idea remains as potent today as it was in 1922. USAA stands as a towering testament to the power of a niche strategy. They proved that you could build an empire not by casting the widest possible net, but by weaving the strongest one. They didn't just find a demographic. They served a community. They built their brand not on clever marketing slogans, but on a shared code of conduct. They looked at a group the rest of the world deemed uninsurable, and saw integrity, honor, and loyalty. And by betting on those qualities, they didn't just create a successful company. They created a legend. USA drew a line in the sand, defining who was in and who was out, and built a financial fortress on that foundation. But what about the companies that took the opposite approach? The ones that tried to erase the lines entirely, that saw opportunity not in exclusivity but in radical inclusivity. What happens when you decide to insure absolutely everyone, even the drivers that every other company has rejected? You have to invent a whole new way of doing business. You have to build a system based on a fundamentally different premise. Not, how can we avoid risk? But, how can we accurately price risk? This isn't just a slight adjustment in thinking. It's a seismic shift in the philosophy of insurance. It's the difference between a nightclub with a velvet rope and a bouncer, and a 24-hour diner that serves anyone who walks through the door. No questions asked, as long as they can pay for their coffee. This new model gave birth to what we now call the non-standard auto insurance market. And while many companies operate in this space, one of its earliest and most successful pioneers is a name you definitely know, but whose origins you probably don't: Progressive. Today we see Progressive as a giant, a top-tier competitor with Flo and the Name Your Price tool. But they didn't start there. Back in 1937, two young lawyers, Joseph Lewis and Jack Green, saw a market that every other insurance company was actively running away from. They saw all the so-called bad drivers, the young, the inexperienced, the ones with a spotty record, and they didn't see liabilities. They saw customers, millions of them. They realized that telling a massive group of people no was a terrible business strategy. The real opportunity was figuring out a way to tell them yes. But saying yes to a driver with a DUI and 2 accidents is financial suicide if you use the same rulebook as everyone else. So they threw out the rulebook. Instead of broad categories like good driver and bad driver, they started slicing the data thinner than anyone had before. They became obsessed with statistics, with probabilities, with finding the precise mathematical line where a specific driver with a specific history in a specific car became profitable. They were the original data scientists of the insurance world, decades before the term even existed. This led to the core innovation of the non-standard market: granular risk pricing. A traditional insurer might look at a driver with a speeding ticket and just hike their rates by a flat 20%. A company like Progressive in its early days would ask, how fast were they going? Was it in a school zone? What time of day was it? What's their payment history like? Is this their first ticket or their 5th? Each answer would tweak the final price up or down. They weren't selling one-size-fits-all policies. They were creating bespoke financial instruments tailored to an individual's exact level of risk. And this is where a mysterious-sounding document comes into play: the State Route 22. If you've ever been in serious trouble behind the wheel, you know these 3 letters all too well. Most people think it's a type of insurance. It's not. And State Route 22, or a Certificate of Financial Responsibility, is basically a note from your insurance company to the state DMV that says, hey, we've got this one. We are guaranteeing that this high-risk driver has at least the minimum required liability coverage. Getting a court order for an State Route 22 is a driver's scarlet letter. Tells the world you messed up badly. And for many standard insurers, it's an automatic deal breaker. The second they see that requirement, your cancellation notice is in the mail. But for the non-standard companies, the State Route 22 wasn't a red flag. It was a green one. It was a signal that a customer was in a desperate situation, mandated by the state to get insurance, and had very few places to turn. They became experts at filing SR22s, integrating the process seamlessly, turning a bureaucratic nightmare into a simple, albeit expensive, transaction. They sold a solution. They sold the ability for someone to get their license back, to drive to work, to put a mistake behind them. This focus on solving a problem, rather than selling a prestigious product, informed their entire business model. Think about it. If your customers are often in a tight financial spot, you can't ask for a huge annual premium upfront. So, these companies pioneered flexible payment options. Monthly installments, low down payments, pay by phone. These things are standard now, but they were revolutionary ideas born out of the necessity of serving a cash-strapped market. They also mastered efficiency. They couldn't afford fancy downtown offices and armies of agents whining and dining clients. Their mantra was lean, fast, and direct. Get the customer a quote in minutes, get their paperwork filed, get them legal, and get them on their way. This is the DNA behind a company like the General. Their advertising, with the cartoon general and the simple jingle, isn't trying to win awards for cinematic quality. It's designed for maximum efficiency. Communicates one thing over and over. If you've been turned down everywhere else, we can help you, and we can do it right now. There's no judgment, no lengthy interviews. It's a pure, unadulterated transaction. They strip the insurance process down to its bare essentials. Of course, this approach comes with a reputation. For decades, the non-standard market was seen as the subprime lender of the insurance world. The policies were often bare bones, offering only the state minimum liability. The customer service might not have been white glove, and the prices, while offered in manageable chunks, were, on an annualized basis, incredibly high. But they had to be. When your entire customer pool consists of people statistically more likely to file a claim, your average premium has to be higher to cover those inevitable losses. It's just math. But here's the fascinating twist in the story. The very tools and strategies that were invented out of necessity to serve the highest-risk drivers ended up revolutionizing the entire industry. The good drivers, served by the big, established companies, started to look at this and wonder. The data-driven, hyper-personalized pricing model that Progressive and others perfected in the non-standard market was just better. It was more accurate. It was fairer. Why should a driver with a perfect record who lives in a safe neighborhood pay the same as a driver with a perfect record who lives in a high-theft area and has a long commute in heavy traffic? The old model lumped them together. The new model, the non-standard model, could tell them apart. The mainstream giants saw the writing on the wall. They saw Progressive growing from a niche high-risk player into a genuine threat that was starting to steal their best customers by offering them a more accurate, and therefore often cheaper price. So they had to adapt. They began to adopt the same data-heavy techniques. They started looking at credit scores, a practice pioneered in the non-standard market to gauge financial responsibility. They developed their own complex algorithms. They started to slice their own customer base into thinner and thinner segments. In a way, the strategies designed for the worst drivers forced the entire industry to get smarter, more precise, and more competitive for everyone. The radical inclusivity of the non-standard market, the willingness to say yes to everyone, ultimately led to a system where your individual driving habits, your personal data, mattered more than ever before. The revolution that started in the industry's basement eventually took over the whole building. This brings us to a crucial point in the evolution of insurance. We've seen how companies were built to serve the riskiest drivers on the road. They created a model based on data, accessibility, and pricing that could withstand a constant barrage of claims. But what if you flipped that idea completely on its head? What if you built a company with the most fortified walls and the strictest velvet rope imaginable? A company that doesn't just want good drivers but the absolute best of the best, and is structured to reward them in a way no traditional company ever could? That company is Amica Mutual. And the secret, the entire revolutionary concept, is hidden in that second word, mutual. It sounds simple, almost boring, but I promise you, understanding the difference between a mutual insurance company and the standard stock insurance company is like being handed a secret key to the entire industry. It fundamentally changes the entire equation of who they work for. See, almost every big-name insurer you can think of, the ones plastering their mascots all over your television, is a stock company. That means they are owned by shareholders. They are publicly traded on Wall Street. Their primary legal fiduciary duty is not to you, the policyholder. It's to their investors. Every decision they make, from setting premium rates to approving or denying a claim, is viewed through the lens of one critical question. How does this maximize shareholder value? This creates a natural, unavoidable conflict of interest. Your desire to pay less and receive more on a claim is in direct opposition to their goal of collecting more and paying out less to boost profits for Wall Street. It's the fundamental tension of the modern insurance industry. A mutual company throws that entire model into the fire. A mutual insurance company is not owned by Wall Street investors. It's owned by its policyholders. You. If you have a policy with Amica, you are not just a customer. You are a part owner of the company. Their legal fiduciary duty is to you. There are no outside shareholders demanding a bigger piece of the pie. The entire structure is designed to serve the collective good of the members, the people who actually pay the premiums. This isn't some new age tech startup idea. Amica was founded way back in 1907. Its founder, A.T. Vigneron, saw that inherent conflict in the stock company model and envisioned something different. He imagined an organization where the focus wasn't on quarterly earnings reports, but on long-term stability and service for the people it promised to protect. He built the company on the principle that if you bring together a pool of responsible, low-risk individuals, they can essentially insure each other, cutting out the Wall Street middleman and sharing in the success. And that's where the fortified walls and the velvet rope come in. For this model to work, you can't let just anyone in. If the company is owned by the policyholders, then every high-risk driver, every person with a history of accidents and claims, represents a direct financial threat to all the other owners. A single fraudulent or expensive claim isn't just a loss for some faceless corporation. It's a loss that comes directly out of the collective pot that belongs to everyone. So Amica became notoriously selective. Their underwriting process is one of the most rigorous in the industry. They don't just pull your motor vehicle report. They look at your insurance history, your claims frequency, your credit history. They build a comprehensive picture of you as a risk. They are, in essence, curating their membership. They are looking for the drivers who are the least likely to cost the group money. It might sound harsh, but it's the very mechanism that protects the members from each other and allows the system to work. By insuring only the safest drivers, their overall number of claims is drastically lower than the industry average. They spend less on repairs, less on lawsuits, and less on administrative costs for processing claims. The result? The company becomes highly profitable. But here's the magic. In a stock company, that excess profit would be packaged up and shipped off to shareholders as a dividend. It's their reward for investing. At Amica, because the policyholders are the owners, that profit comes back to you. It's returned in the form of an annual dividend check. Let me repeat that, because it's a concept so foreign to most people's experience with insurance. Amica literally sends a portion of their profits back to their customers. It's not a rebate. It's not a discount. It's a dividend, a return on your ownership stake in the company. These dividends aren't guaranteed, they depend on the company's financial performance each year. But for decades, Amica has consistently paid them out. Policyholders often receive a check that amounts to as much as 20% of their annual premium. Think about the psychological power of that. Your auto insurance bill, typically one of the most resented expenses in any household budget, suddenly transforms. It's no longer just money disappearing into a black hole. It's an investment in a collective. You are paying into a system where your own good behavior and the good behavior of your fellow members directly results in you getting money back in your pocket. It completely realigns the incentives. You find yourself wanting the company to be strict. You want them to deny fraudulent claims. You want them to be profitable because their profit is your profit. This ownership structure also explains their legendary customer service. For 24 years in a row, J.D. Power has ranked Amica #1 in customer satisfaction for homeowners insurance. Their auto insurance rankings are consistently at the very top. Why? Because when you call them, you're not just a customer they're trying to get off the phone. You're an owner. The service representatives aren't just serving a company. They're serving the company's proprietors. It fosters a culture of respect and genuine help that is incredibly difficult to replicate in a stock company where service is often seen as a cost center to be minimized. So, is Amica for everyone? Absolutely not. Their strict underwriting means many people won't qualify. If you have a spotty driving record, a few at-fault accidents, or poor credit, you likely won't make it past the velvet rope. And their premiums, before you factor in the dividend, are often not the absolute cheapest on the market. They aren't competing to be the bargain basement option. They are competing to be the best value option for the lowest risk drivers. Amica represents a fascinating and powerful corner of the insurance world. A throwback to a time when a company's purpose was aligned with its customers, not with the stock market. It's a financial fortress built on the simple, powerful idea of collective responsibility. They proved that if you build a club with the strictest entry requirements, the rewards for those who get inside can be extraordinary. But this model, this high-touch, exclusive, service-oriented approach, is only one way to build an empire. While Amica was quietly perfecting its members-only club, another revolution was brewing. A revolution based not on exclusivity, but on radical accessibility. Not on high-touch service, but on stripping the process down to its bare, essential core. What if you took the opposite approach? What if you decided that the key to winning wasn't to build a better, more personal relationship with the customer, but to remove the human element almost entirely? To build a massive, efficient, direct-to-consumer machine that could slash costs so dramatically it could change the price of insurance for everyone? What if you could convince millions of people that 15 minutes could save them 15% or more? That question, that simple, powerful slogan, became the foundation of an empire. The answer was a resounding yes. You could. And in 1936, a man named Leo Goodwin Sr., along with his wife Lillian, decided to prove it. They founded the Government Employees Insurance Company. You know it today as Geico. And that name wasn't an accident. It was the entire business plan. Goodwin, working for another insurer in Texas, had a revelation. A lightning strike moment of clarity that would change the industry forever. He realized that not all drivers are created equal. Certain groups are statistically safer bets. They get into fewer accidents, they file fewer claims. And in the 1930s, one of the most stable, reliable, and predictable groups of people in the entire country was federal government employees. In the midst of the Great Depression, while the rest of the country faced economic chaos, government workers had job security. They were a known quantity. Goodwin's genius was to realize you could build an entire insurance company by targeting only this low-risk group. It was like a casino deciding to only let card counters play, but only if they agreed to bet against themselves. But the masterstroke wasn't just who they targeted, it was how. In an era where insurance was sold face-to-face by a local agent in your town, Geico did something radical. They went direct. No agents. No commissions. No expensive branch offices in every town square. They would reach their carefully selected customers through the mail and later the telephone. By cutting out the middleman, they could slash their operating costs to the bone. This wasn't just a small tweak to the business model. It was a complete reinvention. This low-cost structure was Geico's superpower. It was the engine that allowed them to offer lower premiums than almost anyone else and still be wildly profitable. For decades, Geico grew steadily, a quiet giant serving its niche market of government and military personnel. It was a well-run, profitable, but relatively unknown company outside of its target demographic. And then, a 20-year-old student at Columbia University took a train to Washington, D.C. on a Saturday. That student's name was Warren Buffett. Buffett, studying under the legendary father of value investing Benjamin Graham, who happened to be the chairman of Geico's board, was obsessed with the company. He arrived at their headquarters on a weekend to find it closed. But he saw a light on and knocked on the door until a custodian let him in. He asked if anyone was there, and the custodian pointed him upstairs to a single executive working on a Saturday, Lorimer Davy Davidson. What followed was a 4-hour masterclass. Davidson, who would later become CEO, patiently explained the entire Geico business model to this intense young man. He laid out the cost advantages, the underwriting discipline, the massive unbreachable competitive moat that was their direct-to-consumer structure. For Buffett, it was like seeing the blueprints to the Death Star. He saw a simple, brilliant, understandable business that was practically a money-printing machine. He went back to New York and shortly after put more than half of his entire net worth into Geico stock. It was the beginning of a lifelong love affair. But the story isn't a straight line to the top. In the mid-1970s, Geico almost died. In a reckless pursuit of growth, the company's management forgot the secret to their own success. They abandoned their underwriting discipline. They started insuring higher-risk drivers, people outside of their core low-risk demographic, and they didn't charge enough to cover the inevitable claims. The losses mounted at a terrifying speed. The stock, which had been a Wall Street darling, collapsed by over 97%. The company was teetering on the edge of bankruptcy. This is where the story could have ended. But a new CEO, Jack Byrne, was brought in to perform emergency surgery. He was brutal and effective. He fired nearly half the workforce, closed over 100 offices, and jacked up premium rates by an average of 40%. Most importantly, he went back to basics, shedding millions of high-risk policyholders and refocusing on the company's core, profitable customers. And who was watching from the sidelines, ready to pounce? Warren Buffett. He saw that the crisis wasn't a problem with the fundamental business model. The low-cost machine was still there. It was a crisis of management. As others were panicking and selling, Buffett, through his firm Berkshire Hathaway, started buying. He bought millions of shares when the company was on its deathbed, correctly betting that the turnaround would work. It was one of the most legendary investments of his career, and he never stopped buying. By 1996, Berkshire Hathaway had purchased every last share, taking Geico private and making it a cornerstone of his legendary holding company. With the full backing of Buffett's billions and his mandate to focus on long-term growth over short-term profits, Geico was unleashed. They had the perfect business model and a nearly unlimited checkbook. What did they do? They built one of the most formidable marketing machines in the history of American business. They understood that their biggest obstacle was no longer just reaching government employees. It was reaching everyone. They needed to become a household name. And they did it with a relentless, inescapable, and brilliantly simple advertising strategy. The message was always the same: Geico is cheaper. The delivery, however, was anything but ordinary. It started with a simple mispronunciation. People kept calling Geico Gecko. So, the Martin Agency, their ad firm, leaned into it. They created a charming, polite, British-accented lizard. The Geico Gecko became an overnight sensation. But they didn't stop there. They threw everything at the wall. The disgruntled, sophisticated caveman, the hump day camel, the little pig crying wee 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 all the way home, Maxwell the pig, the rhetorical questions with celebrity spokespeople. The strategy was saturation bombing. They spent and still spend billions of dollars a year on advertising, more than almost any company on earth. And here's the key that connects it all back to Leo Goodwin's original idea. They can afford to spend that much on advertising precisely because they don't have agents. The money that traditional insurers pay in commissions, Geico plows directly into marketing to acquire customers. That ad budget isn't a cost. It's the modern digital version of the mail-order catalog they started with in 1936. It's the engine of their direct-to-consumer machine, now operating at a scale Goodwin could have never imagined. Today, Geico is the second-largest auto insurer in the United States, a testament to a brutally efficient business model, the genius of Warren Buffett's investment, and the sheer power of a talking lizard. The company is a perfect fusion of old-school financial discipline and new-school marketing dominance. They proved that you could build a behemoth not on relationships but on efficiency, not on handshakes but on a promise delivered through a television screen or a smartphone app. Give us 15 minutes and we'll probably save you money. Geico's success became the blueprint. They demonstrated that the direct model wasn't just viable, it was superior. But in doing so, they painted a massive target on their own back. Other companies were watching, learning, and adapting. They saw the power of building a brand directly with the consumer, of using a memorable character to cut through the noise. And one competitor in particular decided to take that playbook and turn it up to 11. What if you didn't just have a gecko? What if you had a person? A superstore of insurance, personified by a single relentlessly cheerful woman in a white apron who promised not just a price, but a name-your-own-price tool? That character, of course, was Flo. And the company was Progressive. If Geico weaponized humor and simplicity, Progressive weaponized the idea of choice itself. They didn't just enter the price war. They reframed the entire battlefield. The Name Your Price tool was a stroke of marketing genius. It wasn't a magic button that gave you any price you wanted. It was a clever interface that showed you what level of coverage you could get for the budget you entered. But the psychology was profound. Flip the script. Instead of the insurance company telling you what you would pay, you were telling them what you wanted to pay. Put the customer, for the first time, in a perceived position of power. Progressive built an entire brand around this concept of consumer empowerment. Their Superstore commercials weren't just about Progressive. They showed Progressive alongside its competitors. It was a shockingly confident move. They were so sure their offerings were superior that they were willing to show you the other options right then and there. This built a level of trust that was unheard of. They weren't hiding anything. They were opening the curtain and saying, "Go ahead, look around. We know you'll be back." And then they took it a step further. They pioneered the widespread use of telematics with Snapshot. This little device you plugged into your car was a direct challenge to the old way of doing things. For a century, insurance rates were based on proxies for risk: your age, your gender, your zip code, your credit score. Progressive said, "Forget all that. What if we just priced you on how you actually drive?" It was a radical proposition. Good drivers could finally be rewarded for their actual behavior, not for the demographic box they fit into. It was the ultimate expression of fairness and control, a direct data-driven contract between the insurer and the insured. So as we look back at this list, we see it's not just a collection of companies. It's an evolution. State Farm built the foundation on personal trust and community presence, the agent who knows your name. Allstate played on our deepest fears, offering a comforting promise of good hands in a world of mayhem. USAA proved the immense power of serving a dedicated, unified community with unwavering loyalty. Then came the disruptors. Geico used technology and relentless humor to make insurance cheap, fast, and easy. And Progressive gave us the tools, the choices, and the data to feel like we were finally in the driver's seat. These giants, each with their own philosophy, have shaped the very landscape we navigate today. The official list is a reflection of our own changing values as a society. We moved from wanting a neighborly handshake to wanting the cheapest price to wanting the most control. Each company rose by understanding and capitalizing on one of these fundamental human desires. But this list is far from over. The ground is shaking again. And the next disruption won't be a clever gecko or a cheerful woman in an apron. It's going to be driven by forces that will make the shift from agents to 1 to 800 numbers look like a minor tremor. First, there's the data. Snapshot was just the beginning. Today, it's not just a plug-in device. It's the app on your phone. It's the connected technology built directly into your car's dashboard. Every trip, every heartbreak, every sharp turn, every moment of acceleration is becoming a data point. The future of insurance pricing is hyper-personalization. Your rate could change month to month, or even week to week, based on your real-world driving habits. This promises the fairest system ever conceived. You pay for exactly the risk you represent. But it also opens up a Pandora's box of privacy concerns. How much of our lives are we willing to trade for a better rate? Where do we draw the line between prudent risk management and invasive surveillance? Second, artificial intelligence is changing the game after you have a crash. The days of waiting for an adjuster to come out, inspect your car, and write up a report are numbered. Soon, you'll simply take a few photos of the damage with your phone. An AI will instantly analyze those photos, cross-reference them with a database of millions of claims, assess the cost of repairs, and in many cases, deposit the money directly into your account within minutes. This promises incredible speed and efficiency, but it also removes the human element of empathy and negotiation from one of the most stressful experiences a person can have. But the biggest, most existential change of all is the car itself. For over 100 years, the entire concept of auto insurance has been built on a single, simple premise: human error. Over 90% of all accidents are caused by a mistake made by a human driver. We get distracted, we get tired, we make poor judgments. Auto insurance exists to manage the financial risk of those inevitable human failings. So what happens when the human is no longer driving? Self-driving cars aren't a question of if anymore, but when. And when a fully autonomous car causes an accident, who is at fault? Is it the person in the owner's seat who wasn't even touching the wheel? Is it the car manufacturer like Tesla or Ford? Is it the company that wrote the software that made the decision like Google's Waymo? Is it the company that made the sensor that failed to see the obstacle? This single question threatens to bring the entire multi-hundred-billion-dollar auto insurance industry to its knees. The very concept of personal liability, the bedrock of the system, evaporates. The risk shifts from millions of individual drivers to a handful of massive tech and manufacturing corporations. The official list of insurance companies we've just explored might become a historical artifact. The future of coverage might look more like product liability insurance, bundled into the price of the vehicle itself, than the personal policies we buy today. So after this entire journey, what's the final takeaway? Where does this leave you, the driver, the consumer, the person who just wants to be protected without getting ripped off? It leaves you in a position of unprecedented power. The competition we've detailed, the technological arms race, the constant battle for your business, it all benefits you. The world where you had one local agent and you took the price he gave you is gone forever. The key is to understand what you are buying. You are not just buying a price. You are buying a philosophy. Do you value a human connection? Then a company like State Farm with its vast agent network might be right for you. Do you value speed, efficiency, and the lowest possible cost? A direct-to-consumer giant like Geico is built for that. Do you want to feel in control? To use data and tools to customize your coverage and prove you're a safe driver? Progressive is your champion. Are you part of the military community? USAA is by all accounts in a class of its own. Don't just get a quote. Ask yourself what you truly value. Read the reviews but understand the complaints. A company that's great at paying small claims quickly might be more difficult on major, complex accidents. A company with a fantastic app might have a frustrating call center. There is no single best insurance company on the official list. There is only the company that is best for you. The landscape of risk is always shifting. The cars we drive, the technology that fills them, and the companies that protect them are in a state of constant, accelerating change. But by understanding the history, the players, and the forces shaping the future, you are no longer just a passenger. You can navigate the market with confidence, find the value you deserve, and take control of the wheel.